Hi there, tax accountants. I hope all is well, and I pray that as you're viewing this video that you're in the best of health and spirit. This video will cover several questions from Chapter 9, which covers employment taxes, estimated taxes, and retirement plans, as well as Chapter 12, which covers tax administration and tax planning. So we'll jump right in, and this first question is from Chapter 9, and it asks, Mike performs services for Tatiana. Select each of the following factors and decide whether the factor indicates employee or independent contractor status. So whenever business owners have individuals working for them, it's very important for the business to classify the worker correctly. The worker can either be classified as an employee or they can be classified as an independent contractor. So many taxpayers, they deem, or businesses, they might think that this is a decision that they can essentially make. But in fact, the classification of an employee versus an independent contractor, it's a function of law, and it's not a choice that the employer or the employee can make. It's a very important thing to consider. Reason being is because, let's say an employer, they hire someone and treat them as an independent contractor when they should be treated as an employee, there are very, very hefty fines. So there's some characteristics that help to determine the degree of control and the independence, and it falls into three categories. The first is behavioral, right? So does the business control, or do they have the right to control what and how the worker does their job? If so, then they're more than likely an employee. There's also financial. Are the business aspects of the worker's job controlled by the payer? So what happens if, there's expenses that exceed the payment? Are they going to be reimbursed? And lastly, relationship. Are there written contracts? Are there employee benefits? What happens, in continuity? Is their relationship going to continue? So these are some key things. In addition, there's a form called SS8. We'll actually look at it quickly. And this basically helps to determine, based on the law, whether or not the employee, or the worker rather, should be classified as a worker or an independent contractor. So as we see here, it's a 5-page document, determination of worker status for purposes of federal employment taxes and income tax withholding. So one of the key reasons why this is so important is because as an employee, the employer is required to withhold and remit Social Security as well as Medicare taxes, and then the employer also matches that. On top of it, as an independent contractor, you just pay the individual the gross amount, and they are responsible for their own taxes. So a lot of reasons why, we'll see as we go through this chapter, why employers, they rather just treat workers as an independent contractor versus an employee. So we're going to jump into answering the question. So here it says, Mike works only for Tatiana. So in this case, more than likely be an employee, because independent contractors, they generally work for multiple businesses. B says Mike sets his own work schedule. So in such cases, an independent contractor, because as an employee, you're more likely to be required to comply when the work is done. So your boss will tell you, hey, you have to come in from 9 to 5, 8 to 4, or 11 to 7. So as an employee, you generally don't have that liberty to set your own schedule. C, Mike obtained his job skills from Tatiana's training program. So generally, employees, they're trained by the hiring party. So more than likely an employee in this case. Mike performs the services at Tatiana's business location. So the business controls where the work takes place. This is more than likely an employee. E states Mike is paid for time worked rather than the task performed. This would also be like an employee. Independent contractors, they're generally likely to be paid based on the completion of a project. F, Mike works for Tatiana on a continuing basis for the entire year. So this is generally an employee. Independent contractors, generally there's a set time frame, especially like with tax season coming up. There are companies that would hire you for tax season, whether it's tax preparation or tax review. And then what happens after the tax season, you no longer have a relationship with the company. They're not required to keep you for the extension season or the next tax season. So generally, there's a cutoff point with independent contractors. G states if Mike's costs exceed his payments, Tatiana will cover the shortfall. So this is an example of an employee. Generally, when you're an independent contractor, the independent contractors, they bear the risk of a loss. H states, if Mike stops working on a project, Tatiana will have no remedy for the breach of contract. This would also be an employee. Employees, they could just decide to quit and it won't breach a contract, versus if you're an independent contractor and you sign in a written agreement that, hey, I promise that I am going to complete this project before a certain date, and let's say the independent contractor doesn't do the work, then they're breaching the contract. So again, these are just some key things that business owners, they need to make sure of, because you don't want to get into problems where the individual, let's just say, Uncle Sam gets a whiff of it. There are some very hefty fines and penalties, as mentioned, for incorrectly classifying a worker. So we'll move on to the next question. And here it states, the classification of a worker as an employee or an independent contractor is it based on a set of common law factors related to control and independence? So we mentioned this seems to be the correct answer. Is it based on a negotiation between the employer and employee? Nope, it's not a decision that they can make or negotiate. Is it made by the employer? No. Is it made by the employer? No. So A is our correct answer. It's based on a set of common law factors related to control and independence. And as we mentioned, it falls into three categories: behavioral, financial, and relationship. In the IRS, they released a list of 20 factors to consider in classifying the worker as either an employee or an independent contractor. And just keep in mind that the degree of importance for each factor, it can vary, and there's no single factor that is controlling. Here it asks, Lambden Company pays its employee Trudy wages of $63,000 in 2023, and it's asking us to calculate the FICA tax. So we have an Excel spreadsheet. And we're going to use that to calculate. So there's some key things we know about FICA. We know FICA stands for Federal Insurance Contributions Act, and we know that there's some key things as it relates to FICA taxes. All right, so we know that the Social Security rate is 6.2% and the Medicare rate is 1.45%. And again, as we just learned about businesses having to classify their workers correctly, this is one of the reasons why employers, they'll rather just have an independent contractor, because now they need to match 7.5%, which is the total of 7.65 rather, which is the Social Security plus the Medicare. And then in addition, they also need to pay what's called FUTA tax, which is federal unemployment tax. So there's extra money that employers need to shell out if a worker is classified as an employee. So in this case, it says Lambden Company, they paid Trudy wages of $63,000. So we need to determine how much is going to be withheld from Trudy's wages for Social Security and Medicare taxes, and how much is going to be paid by Lambden, the company, because again, the company is going to match the FICA taxes. So for Trudy, her wages are $63,000. We multiply by the Social Security rate of 6.2%. So 3,000. I think this number is wrong. Percentage should be 6.2%. 6.2. All right, perfect. There we go. So 6.2. Let me just update these numbers. All right, so in this case, $3,906. So 63,000 times 6.2%, $3,906 for Social Security. For Medicare, the wages are the same, 63,000 multiplied by the Medicare rate of 1.45. So 63,000 multiplied by 1.45. This is also incorrect. Percentage, got to make sure the percentage is correct. So 1.45. All right, so $913.50. So Social Security, $3,906. Medicare, $913.50. So now if we consider the employee wages, remember, the employer is matching, so we actually don't even need to do any extra math, but just so you see, again, same thing. Wages remain the same. The Social Security rate is the same. Nothing changes. So $3,906 needs to be paid for Social Security. And then the same thing for Medicare. 63,000. So we basically, could just copy the numbers pretty much. So 3,906, $913.50. So now we want to determine the total FICA taxes. So we can just take the sum. There's two ways we can answer this, but we can add all of them up. And that will give us a total of $9,639. Or what we can do is add the Social Security taxes plus the wages, and then we multiply it by 2, because again, the employer is going to be matching. We'll get the same number, 9,639. All right. So that's our answer. And again, this is one of the reasons why businesses, they don't want to treat individuals as employee, because look, now this company has to shell out an additional, let's add it up. They have to shell out an additional $3,906 and $913. So now they need to pay an extra $4,820. Some employers, they don't want to deal with that, right? They want to conserve money. So again, just something to keep in mind. So we'll move on to the next question. Here is another fee that employers need to pay. So in this question, we saw that the employee pays a portion and the employer pays a portion. We have what's called FICA tax, and this is covered 100% by the employer. So with the FICA tax, this is the federal unemployment tax rate, and this is a statutory percent of an employee's wages up to a statutory threshold. So FICA tax is an unemployment tax with a rate as low as 0.6% on wages up to $7,000 per employee. That seems correct, but we'll go through all of them. B states an unemployment tax with a rate of 2.9% on wages up to $160,200 per employee. That's incorrect. And we can rule out C and we can rule out D, because the FICA tax is for unemployment. It is not for disability. So we can rule out C, rule out D, and we can also rule out B. The correct answer is A. So employers, they'll have to report their FICA liability on what's called Form 940, and they will report it annually. And much like the federal income tax, withholding, and FICA taxes, these federal unemployment taxes, they will need to be deposited using what's called EFTPS. And there's, different rules regarding when it needs to be deposited. But again, much like the withholding for FICA taxes, the FICA taxes also need to be deposited. So it's not like the employer is withholding the taxes from the employee and they're just keeping it throughout the year. Uncle Sam doesn't play that, because imagine, right? If a company, they're facing financial issues, they would probably use the employees' taxes that have been withheld as money to help run the company in anticipation that they are going to, get the money back. Uncle Sam is not playing that. So therefore, based on the amount of taxes that are being withheld, that ultimately determines how often the employer needs to deposit those funds. And if they don't, there are some hefty fines. All right, so we move on to the next question. Here is asking, which of the following best describes the purpose of Form W-4? So Form W-4 is essentially used to report for the employee. It essentially determines how much taxes the employer should withhold. So employers, they're required to withhold income and employment taxes from the amounts that are paid to employees for their wages. So keep that in mind. Yes, employees pay Social Security and Medicare taxes, which are our FICA taxes, but they're also required to withhold income taxes, which is federal and state level, depending on which state you live in. So A states, report year-to-date compensation and withholding for all employees of an employer. This is incorrect. B states, report the compensation of a non-employee worker. This is incorrect. This would be reported on 1099 NEC. And for A, that would essentially be Form 941, which would report all of the compensation, the withholdings. C, this would be Form, what is it called? There's a 1096. Form 1096, which basically confirms the total amount. That will be for 1099s, and then Form W3 would essentially report the year-to-date compensation and withholding. So A would be Form W3, B would be Form 1099 NEC, and C states report year-to-date compensation and withholding for a single employee. This would be Form W2. So A is incorrect, B is incorrect, C is incorrect, D is our correct answer. Report the information necessary for an employer to withhold income tax from an employee's wages. This question asks, which of the following forms is used to report non-employee compensation? So we just saw this. So we know the answer, but we go through each of them. We have Form W2G, and this reports gambling winnings, so that's not the answer. We have Form 1099 composite. So generally, this is issued by a brokerage company, and let's say someone has an account with Morgan Stanley. If an individual received dividends, they received interest, and they also sold stocks and bonds, instead of just sending a 1099 DIV, a 1099 INT, and a 1099B separately, what these brokerage companies generally do is they would issue a 1099 composite. So there will be one file that will be sent to the taxpayer that would list the total interest. It would list the total dividends, and will also list the stock sale. So that's what a 1099 composite is. It's basically a combination of multiple forms. For a taxpayer, 1099-G, this can be used for various purposes. It could be used for unemployment payments. On a 1099-G, you would also see state refunds in certain cases. Refunds from the state might be taxable. 1099 NEC is our answer. 1099 miscellaneous, this is essentially if someone receives, other income or payment for royalties and things of that nature. Generally, the 1099 NEC is more so like a new form. 1099 miscellaneous used to be issued, but the problem is that individuals who were self-employed, they would just report it as other income. And Uncle Sam, as we know, don't play that. Individuals, they were not reporting that the income received was from self-employment. Hence, Uncle Sam was losing money because self-employment taxes were not being reported and paid. So now if you are self-employed, instead of giving a 1099 miscellaneous, they're given a 1099 NEC, and that indicates that, hey, this person is self-employed and they should be subjected to self-employment taxes. So D is our correct answer. For this question, it states, for each of the following payments, indicate the form that should be used to report the payment. We have interest of $400 paid to a bank. So this would be 1099 INT, 1099 interest. Payment of $400 in dividends by a corporation to a shareholder. This would be 1099 DIV, dividend. Periodic payments from a retirement plan. This will be reported on 1099-R. Salary as president of a company, they would receive a Form W2. Las Vegas keynote winnings of $25,000. This will be reported on Form W2G for gambling. And lastly, payments made to a non-employee, as we just learned, would be reported on Form 1099 NEC. So as a tax professional, it is definitely important to familiarize yourself with these different forms, so that way, you understand how they're going to be treated. We know that interest is treated as, or taxed as ordinary tax rates. Dividends, we know that we're going to need to look to see, hey, are there any qualified dividends? Because qualified dividends are treated and taxed at preferential tax rates similar to long-term capital gains. When we're dealing with retirement, we know that in certain cases, it depends. Was it a Roth IRA? In such case, we're going to need to determine, hey, does the client know their basis? W2G, how much did the client pay, or how much did they spend for gambling? Because we know that sometimes a portion of it can be subjected to itemized deductions, but it's limited to the winnings. So there's a lot of different things to essentially factor in as you are, preparing taxes. You want to familiarize yourself with these forms. Next, we move on to what's called estimated payments. So in the case where an individual is an independent contractor, they're not working for a company, they don't have anyone withholding taxes on their behalf. Their employer is not withholding taxes. Again, they're being paid the gross amount. So in such cases, those self-employed individuals, they need to pay estimated taxes because you know what? Uncle Sam ain't having it. Uncle Sam is not just going to wait until the tax season to receive their funds. So we have what's called estimated payments. And with these estimated payments, that is where individuals who are self-employed, or let's say individuals who they have a job, however, they receive income that's not subjected to taxes. So maybe they receive a lot in interest or dividends, or maybe they have a rental property or a pass-through entity, a partnership or something like that, right? That individual, they're anticipating having income being reported that no taxes are being taken out for. So therefore, in those cases, those individuals, it's encouraged to pay estimated taxes, and it's even further encouraged and enforced because if they don't pay enough, Uncle Sam hits them with a underpayment penalty. So typically, estimated payments for individual taxpayers are due on the following dates. They are 4 installments. It's paid 4 times a year. So we know that we can rule out B and we can rule out C. So here it says 4 installments on April 15th, June 15th, September 15th, and January 15th. And B states 4 times a year on April 15th, July 15th, September 15th, and December 15th. So that is incorrect. So A is our correct answer. There's 4 installments. And again, April, June, September 15th of the current year, and then January 15th of the year following. So as it relates to these estimated tax payments, so generally an individual taxpayer, if they have estimated tax for the year of $1,000 or more after subtracting their withholding, and if their withholding doesn't equal or exceed the required annual payment, then in that case, they're required to make these quarterly estimated payments. So the required annual payment is the smallest of the following amounts: 90% of the tax shown on the current year's return, 100% of the tax shown on the prior year's return, or 110%. And that is essentially whenever the prior year adjusted gross income is $150,000 or more. So there is some nuance depending on your adjusted gross income. And in such case, this question is asking, when does the required annual payment for estimated income taxes increase to 110% of the prior year tax liability? So this is whenever the prior year adjusted gross income is $150,000 or more. So it's not when the prior year taxable income exceeds $125,000. That's wrong. Again, it's the adjusted gross income. B is incorrect. It's not when the current year tax liability exceeds $20,000, and it's not when the current year taxable income exceeds $100,000. So D is our correct answer. If the prior year adjusted gross income is $150,000 or less than $150,000 rather, in such case, then their estimated taxes need to equal 100% of the following year. But whenever it's 150,000 or more, then estimated taxes increase to 110%. This question states, Darwin is self-employed in 2023 and expects to make self-employment income of $80,000. What alternative does Darwin have to avoid penalties for failure to pay income taxes? So again, he's self-employed, doesn't want to have to avoid penalties. What does he need to do? He needs to make quarterly estimated payments that are within a few percentage points of his actual income tax liability. He can't pay all of his income tax liability on January 15th of the following year. Again, there's 4 installments: April, June, and September, and then January of the following year. He can't make sure he pays his entire liability when he files, because unfortunately Uncle Sam don't play that, and you will still get hit with a penalty. And D says as long as Darwin pays his liability when he files his tax return, there are no penalties. That is not correct. He needs to pay quarterly estimated payments. All right, so next question, it asks, Amy's prior year adjusted gross income was $170,000. In order to avoid penalties, what is the required annual payment Amy must make in the current year? So we know that it's the lesser of 90% of the current year or 100% or 110% of the prior year's tax liability. And that ultimately depends on the prior year adjusted gross income. So as we learned in the previous problem, the threshold to determine if it's 100 or 110% is the adjusted year gross income. And in this case, we see Amy's prior year adjusted gross income was 170,000. So therefore, she cannot use 100%. She needs to use 110%. So therefore, A would be incorrect. B seems to be our correct answer. C states any amount that reduces the amount Amy owes for the current year to no less than 5,000. Wrong. D, 110% of the current year tax liability. So this is partially correct. It forgot about the 90%. This is actually incorrect, rather, because it says 100% of the current year when it needs to be 110% of the prior year. All right, so correct percentage, but wrong application. It needs to be the prior year. Here we have this question. It states, Kana is a single wage earner with no dependents and taxable income of $168,700 in 2023. Her taxable income in 2022 was $155,000 and the tax liability was $30,500. Here it states, calculate Kana's 2023 income tax liability and Kana's 2023 minimum required annual payment. So here we have these tax rate schedules, and we also have an Excel that's going to help us to determine the answer. All right, so we have some key information so far. It lets us know that she's a single wage earner. No dependents and taxable income is $168,700. So we could plug that in, $168,700. All right, some other things that we need to know in order to avoid a penalty. Here it lets us know 90% of the current year liability, or depending on her income, if 100% of prior liability, if prior AGI is less than 150,000 or more than. So in this case, it says that her taxable income for 2022 was 155,000. Tax liability of 30,500. So in this case, we see that what is going to apply is the 110%. Because again, taxable income of 155,000. So this one applies. So I'll make this green because this is what we're going to need to factor in. So we'll just type it in 30,500, and then on the next slide, we'll calculate the amount. So we have the information we need. Now we go to the chart. So the problem lets us know that she's single, right? Let's double check, single, no dependents. Perfect. So now we look at this information, and we're going to have to determine what's her tax liability. So we use Schedule X if single, Schedule Y1 if married, filing joint or qualified surviving spouse, Y2 if married, filing separate, Schedule Z if head of household. So we're focusing on this one. So here it's asking if your taxable income is over but not over. So in this case, her taxable income is $168,700. So she definitely doesn't fall within these three ranges, right? But her income is over $95,375, but it's not over $182,100. So therefore, based on that, the base tax is $16,290 plus 24% of the amount over $95,375. So base tax of $16,290. And now we need to figure out, well, what is the excess over the $95,000? How will we determine that? So it's $168,700. And I'll actually put it here. So the threshold, which we know is $95,375. So the excess income is the $168,700 minus the 95,375. So the excess income is $73,325. And what the problem is letting us know is that for every amount above 95,375 is subjected to 24%. So the tax rate is 24%. So now our next step is to multiply the excess by the 24%. So 73,325 multiplied by the tax rate of 24%. So the tax on the excess is 17,598. So if we add the two, the base tax of 16,290 plus the excess of 73,325 by 24%, which is 17,598. The total tax liability for Kana is $33,888. So $33,888. Again, so how do we calculate that? I'll go through it quickly. Kana's income is over 95,375, but less than 182,100. So based on that, the tax is a base tax of 16,290 plus 24% for every dollar that is above 95,375. Kana's taxable income was 168,700. We minus the threshold, which is the 95,375. So 168,700 minus 95,375, we get an excess of 73,325. And when we multiply that by 24%, that is how we calculated the tax on the excess of 17,598. We added these two amounts. Therefore, Kana's 2023 income tax liability is 33,888. So now it's asking us, what is Kana's 2023 minimum required annual payment necessary to avoid penalty? So it would either be 90% of the current year tax liability. So the current year tax liability is 33,888, and we'll do the multiplication to the side. So $33,888 multiplied by 90% will be $30,499.20, or 110% of the prior year liability. So again, because her prior year income, as the problem lets us know, was 155,000, we're not using the 100%. We need to use 110%. So 30,500 times 1.1 would be 33,550. So we take the lesser of the two, and in this case, the lesser of the two would be $30,499.20. All right, and the good thing is when you use tax software, the tax software will automatically, determine the estimated payments that need to be paid. Again, you could generate the vouchers, but it's ultimately up to the client if they're going to make it. But for clients that have tax liabilities, you want to give them the option so they know, hey, if you don't pay these estimated payments, you are going to be hit with a penalty. Some clients do it, some don't. But you want, as a tax professional, to make them aware of the implications of not paying enough during the year. So this brings us to our next question. Here it states, indicate whether the following statements are true or false regarding the statute of limitations. So as it relates to the statute of limitations, this is basically the time period within which an action can be taken by the IRS on a tax return. And essentially, after the statute of limitations runs out, then the government, they can't assess any additional taxes, and a taxpayer can't amend the return to request a refund. So in general, the statute of limitations for a tax return, it is 3 years from the date the tax return was filed or the return due date, whichever is essentially later. And if a taxpayer is expecting a refund, then the statute of limitations is the later of 3 years from the time of filing or 2 years from the due date that the taxes were actually paid. So we'll go through these. The general statute of limitations for a return is 3 years. This is true. It's just mentioned. In the event that, let's say, there's an omission, and then it can be 6 years. If this fraud indefinitely. They can always come after you. All right. So one is true. The statute of limitations for a bad debt deduction on a tax return is 6 years. This is false. So the statute of limitations for the deduction of a bad debt or worthless securities, it's 7 years. So just keep in mind this limitation, it applies only to a bad debt deduction or worthless security deduction. All other items on a tax return, they normally close out after 3 years. 3, the statute of limitations for a fraudulent tax return is 7 years. False. Uncle Sam, don't play that. So if a fraudulent return is filed or no return is filed, there's no statute of limitations. The IRS can assess a tax deficiency anytime in the future. 4, the special statute of limitation is 6 years for a tax return that omits greater than 25% of gross income. So this is true. If a taxpayer omits, if they fail to report an amount of gross income in excess of 25% of gross income shown on the return, then in such case, instead of the 3 years, it exceeds to 6. 5 states for the deduction of worthless securities, the statute of limitation is 7 years. This is true, and we learned that from 2. This applies to bad debt deductions and the deduction of worthless securities. It is 7 years. So we continue with statute of limitations, and this question asks, if a taxpayer's 2023 individual income tax return is due on April 15th, 2024, and was filed on March 4th, 2024, the statute of limitations would normally run out on. So as we know, generally the statute is 3 years from the later of the actual filing date or the original due date for the return. So in this case, we see that the return is due April 15th. The taxpayer filed it on March 4th, we take the later of the actual filing date or original date, and we see that in this case, the later is the filing due date. So in such case, it would be 3 years from April 15th, 2024. So the correct answer is April 15th, 2027. Here it asks, in which of the following situations is the burden of proof in a tax matter not automatically shift to the IRS? So in the IRS Restructuring Reform Act of 1988, the tax law was changed. And what that essentially did is that it changed to shift the burden of proof to the IRS in lots of situations. So what that basically means is that the IRS, they have the burden of proof in a court proceeding, whether it's related to income, gift, estate, with respect to factual issues provided by the taxpayer. So what this simply means is that they would need to introduce credible evidence of the factual issue. They would need to maintain records and substantiate them as presently required under the code, the Internal Revenue Code, and they will need to cooperate with reasonable IRS requests for meetings. So that's what the taxpayer needs to do. The IRS, however, they have that burden of proof. So the burden of proof automatically shifts to the IRS in 2 situations. The first is if the IRS uses statistics to reconstruct an individual's return, or if the court proceeding against an individual involves a penalty or addition to tax. So in the event that the taxpayer doesn't maintain a record, because again, there's 3 things that the taxpayer needs to do. They have to introduce credible evidence. They need to maintain records. In addition, they need to cooperate with the IRS. So if a taxpayer didn't maintain records, unfortunately, doesn't shift to the IRS. Next question here states, which of the following have privileged communication with a client in a non-criminal tax matter? So this is also referring to this 1998 Act. It also extended the existing attorney-client privilege of confidentiality in certain tax matters. So as it relates to non-criminal tax proceedings before the IRS or federal courts, the non-attorney-client privilege, it does not extend to written communication between a tax practitioner and a corporation in connection with the promotion of a tax shelter, right? So we know one thing for sure, Uncle Sam, don't play that. So there's certain things that are not allowed, but generally, CPAs, enrolled agents, and attorneys, they essentially have privileged communication with a client, but what they need to keep in mind is that the rules regarding tax confidentiality, as they've been applied to lawyers, they need to understand the tax privilege limits. So for example, tax privilege communication, it doesn't apply to the preparation of returns, doesn't apply if you give accounting or business advice or tax accrual work papers. Also, unlike the general attorney-client privilege, the non-attorney-client privilege, it does not automatically apply to state situations. So some key things to keep in mind. This question, we move on to the Bill of Rights. So as a taxpayer, you do have rights. And in 1988, Congress, they passed a set of provisions, and it's referred to as the Taxpayers' Bill of Rights. And it's been amended several times since it was originally passed, but the key thing is that the set of provision requires the IRS to inform taxpayers of their rights with dealing with the IRS. So I call it the double R. Reason being is because it outlines the rights and it also outlines the rates. So the R stands for the refund process, A stands for appeals, C stands for collection, and E stands for examination. All of this will be outlined in publication 1. So the Taxpayers' Bill of Rights is outlined in publication 1. And again, double R, it outlines the rights. And the second part explains how to handle the rates, how to handle the refund process, the appeal process, the collection process, as well as the examination process. Here it asks us about interest and penalties. And this is, again, in alignment with 1988. This is outlined in the Taxpayers' Bill of Rights. And here it states, if the IRS owes a taxpayer a refund, the law generally provides that the IRS must pay interest on the refund if it is not paid within blank days of the date the taxpayer filed their tax return or claim for refund. The correct answer for this is 45 days. So if you file a tax return and Uncle Sam owes you a refund and they don't send it within 45 days, they will give you interest on top of the refund. Keep in mind, however, if Uncle Sam pays you interest, you are going to receive a 1099 INT, and the interest that Uncle Sam paid you, it is taxable when you file your tax return. So just keep that in mind. Yes, they pay you interest, but you need to report it as income. All right, so here we have this question, interest and penalties. I will get the spreadsheet open. So we have these different scenarios. All right, and in these scenarios, we would need to figure out how much interest and penalty is going to be assessed. So it says, compute the penalty described for the following taxpayers. Here it states, Wilson filed his individual tax return on the original due date, but failed to pay $700 in taxes that were due with the return. If Wilson pays the taxes exactly 2 months, not over 60 days late, calculate the amount of his failure to pay penalty. So taxpayers, they are subjected to penalty for failure to pay the amount of taxes that are due on the due date of their tax return. So we have a failure to pay penalty and we have a failure to file penalty. So something to keep in mind. So the penalty for the failure to pay is 1/2 of 1% of the amount of taxes due for every month or portion of a month that the payment is late. There's a maximum of 25% of the amount of taxes due, and the penalty increases to 1% per month, beginning 10 days if the IRS issues a notice of levy. So in this case, it says Wilson paid the taxes exactly 2 months late. So in order for us to determine, we know the amount of taxes due is $700, and it lets us know it's exactly 2 months. So therefore, the total tax due is $700 times the penalty times the amount of time. What? The amount due times the penalty, perfect, times the amount of time. So therefore, Wilson would need to pay $7. All right, and just keep in mind the problem says, if required, round your answer to 2 decimal places. So that's why we're inputting the 7.00, because if you just put 7, the answer is correct, but gotta read instructions. It says round your answer to 2 decimal places. So now we move on to B. B states, Joan filed her individual income tax return 4.5 months after it was due. She did not request an extension of time for filing. Along with her return, Joan remitted a check for $750, which was the balance of taxes she owed with her return. Disregarding interest, calculate the total penalty that Joan will be required to pay, assuming the failure to file was not fraudulent. So, again, we know if the taxpayer does not file the tax return on the due date, including extensions, he or she is subjected to a penalty equal to 5% of the tax due with the return for every month or portion of the month. The amount of penalty for failure to file, however, is limited to a maximum of 25% of the amount of taxes due with the return. Let's just say the failure to file is fraudulent. In such case, the penalty is increased from 5% to 15%, and the maximum penalty is increased from 25% to 75%. Also, in the event that a taxpayer fails to file a return within 60 days, then the minimum failure to file penalty is the lesser of $485, or the total amount of taxes due with the return. All right, so that was a lot to go through. Let's work through it. So we know we have two penalties. We see the failure to file penalty, which we saw in A. And now we're also going to learn about the failure to file penalty. So the amount due for Joan was $750. And it lets us know here that she filed it 4.5 months late. So keep in mind, the penalty is not just based on a full month. It's based on a month and a part of a month. So it says 4.5 months. So therefore, the time in this case would be 5 months. So the failure to file penalty would be the amount multiplied by the 1/2 of 1%, multiplied by the time, 5 months. So the failure to file penalty will be $18.75, right? But we don't stop there. We need to figure out the failure to file penalty, which we pointed out was 5%. In this case, if both the failure to file and the failure to pay penalty apply, then the failure to file penalty is reduced by the amount of the failure to pay penalty. So that gives us a combined 4.5%. So just keep that in mind. So as we need to calculate the failure to file, we know the amount she paid was $750 and the time was 5 months. So we calculate $750 times the 5% times the months, 5 months. So it's $187.50. But again, because both the failure to pay and the failure to file penalty apply, what we essentially do now is we subtract the failure to pay penalty. So this would be our calculation. We calculated $187.50 and we subtract the failure to file penalty, and that gives us a net failure to file penalty. Now, the next thing we need to do, but again, the return was filed over 60 days. So therefore, we compare the two, the one that's $68.75 to the $485. The $485 is higher. So therefore, in such case, Joan is going to need to pay $485, which is the minimum failure to file penalty, plus the failure to pay penalty. So therefore, the total penalties that Joan needs to pay is $503.75. All right. In 2023, the amount was $450, and it increased to $485. So just keep that in mind. So it used to be $450, the minimum failure to pay. Minimum failure to file penalty if you file after 60 days was $450, and that amount has increased to $485. So again, we took the lesser of the higher of the two, which in this case was $485, because again, failed to pay it over 60 days, $485 is the minimum failure to file penalty, which is obviously less, which obviously in comparison to the net failure to file penalty, this is the minimum amount, doesn't meet it, so $485 automatically, and we add the failure to pay penalty for a total of $503.75. So we move on to C. C states Jack filed his tax return 2 months and 3 days late and did not request an extension of time for filing. Jack's return indicated that he is required to receive a $50 refund in taxes. Calculate the amount of Jack's penalty for failure to file his tax return on time, assuming the failure to file was not fraudulent. Jack is getting a refund, right? The failure to pay and the failure to file, that is generally for individuals who have a balance due. If you're getting a refund, Uncle Sam doesn't charge you anything, all right? They owe you money. So because Jack is entitled to a refund, there is no penalty. All right, so our last few questions here says Linda underpaid her taxes for the current year by $4,000 due to negligence. So as we know, tax law imposes statutory percent penalty of applicable underpayment due to negligence or disregard for rules or regulations, if there's a substantial understatement of income tax, or if there's a substantial valuation overstatement. So in such case, the tax law imposes 20% due to negligence or disregard. So in this case, 4,000 times 20%, Linda's accuracy related penalty for negligence would be 800. Now B states, assume that the underpayment of taxes by Linda was deemed to be fraudulent. Calculate the amount of Linda's fraud penalty. Uncle Sam don't play that. So in the event that an individual, they fraudulently underpay taxes, unfortunately, it's not 20%, it's not 50%, but it's 75%. So in such case, 4,000 times 75%, Linda's fraud penalty is $3,000. All right, so you just don't want to play with Uncle Sam. Okay, so again, negligence 20%, fraud penalty, it is increased to 75%. Here it states, select either true or false for each of the following statements. The tax law includes a penalty for writing a bad check in payment of a taxpayer's liability. This is true. So in the event that a taxpayer writes a check, bad check, they are subjected to a penalty unless the taxpayer, they can demonstrate that the check was issued in good faith. I mean, things happen, you know, sometimes you're waiting for money to come in, it doesn't come in, or you didn't realize something else was being taken out. The penalty is equal to 2% of the amount of the check. And if the check is less than $1,250, then the penalty is the lesser of $25 or the amount of the check. The statute of limitations for a tax return is normally 4 years. This is false. As we learned in the previous problem, it's 3 years. If there's an omission of 25% or more, then it is extended to 6 years. And if there's fraud or no return was filed, there's no statute of limitation. It's indefinite. C, if a fraudulent tax return is filed, the IRS may assess a deficiency at any time in the future. This is true. Enrolled agents work for the IRS. This is false. Enrolled agents are individuals who have passed an IRS exam, and they are allowed to represent clients at IRS proceedings, and they can also prepare tax returns. So it's the equivalent of a CPA. So this is false. E, a commercial tax preparer may represent tax clients in any proceeding with the IRS. This is false. So most taxpayers, they find it desirable or necessary to have their returns prepared by a tax practitioner. So this includes commercial preparers, enrolled agents, attorneys, CPAs. Commercial preparers, they generally prepare non-complex returns. But keep in mind, only enrolled agents, CPAs, and attorneys can represent their clients in proceedings. F, the IRS is entitled to choose a place and time for an audit without regard to the inconvenience to the taxpayer or the reasonableness of the request. This is false. So Congress, again, they passed those Bill of Rights in Publication 1. In the first part of the publication, it explains some of our most important rights as taxpayers. In the second part, again, that is the race, refund process, appeals, collections, and examination. The IRS, they have to set a schedule at a reasonable schedule and audit, at a reasonable time and place that works for the taxpayer. All right, as it relates to tax planning, here it states select either true or false for each of the following statements. Decreasing one's tax liability through legal methods is called tax planning, while illegally reducing taxes is called tax evasion. This is true. Again, tax avoidance is not a problem. That's another word for tax planning. Tax evasion, however, that is illegal, and it can land you in jail and you can also be faced with hefty fines. In a closed transaction, all significant events have been completed. This is true. So this is basically like, think of it like this. A client, they already sold a house and now they're trying to figure out, well, what are the tax implications? An open transaction, however, that is where the client is thinking about selling the house and they want to know what are the implications going to be if we do sell it. So closed, that means the deal is done. Open means they're anticipating and they want to know. They have more leverage in an open transaction because now they can kind of figure out, hey, do I want to move forward with the transaction or not? C, the marginal tax rate is computed as the total tax paid divided by the total income of the taxpayer. This is false. This is how we calculate the average tax rate. All right, so for tax planning purposes, it's definitely important to understand the difference between the average tax rate and the marginal. So the average tax rate, that's basically what's, detailed here, the total tax divided by the total income. The marginal tax, on the other hand, that represents the rate at which the next dollar of income, how much it is going to be taxed by, what the percentage is. And that would be similar to here, right? So when we think about that example for Kana, if Kana, let's say Kana wanted to make a few extra dollars, she wanted to make $3,000 more, her marginal tax rate would be 24%. For every dollar that Kana earns over $168,700, 24 cents per dollar would be subjected to taxes. So that would be Kana's marginal tax rate. All right, D states the marginal tax rate is the most important rate for decision making in a tax planning situation. True, as we just saw. Now Kana needs to decide, hey, do I want to make more money? If so, does it make more sense for me to, well, in that case, she can determine, or she can plan better, rather. Now she can, think of creative ways with expenses and things of that nature, if it makes sense or not, because she'll know every additional dollar is going to be taxed at 24%, the net amount. E, a timing tax planning technique usually has the objective of deferring the tax payment until a later tax year. True. That's one of the key things in its simplest form. Timing implies deferring the payment of taxes to a future year and is generally achieved by either deferring income recognition or accelerating expense deduction. All right, so this brings us to our last few questions. Here it states, Glenn's taxable income is $50,000 and he pays income tax of $6,313. If his income were $60,000, he would pay taxes of $8,513. What is Glenn's marginal tax rate? So in order for us to determine the marginal tax rate, we will calculate it as follows. So we'll get our Excel spreadsheet ready. So in this case, tax due in scenario 1 minus tax due in scenario 2. All right, because again, we're tax planning. We want to know how much, what's going to be the impact. So tax due in scenario 1 will be $8,513 versus scenario 2, $6,313. So we want to see the difference. So in such case, the difference will be $6,000 or $2,200. All right, there will be a difference in tax of $2,200. Next, we need to factor in, all right, well, what is the difference in income? So the difference in income in such case in scenario 1, 60,000 versus the 50,000. So there's a difference of $10,000. So there will be a difference in taxes due of $2,200, and the difference in income would be $10,000. So in order to calculate the marginal rate, we do the following: we divide. So the tax due of $2,200 divided by the difference of income, therefore, the marginal tax rate for Glenn would be 22%. So again, how do we calculate that? We find the difference between the tax that's going to be due, $8,513 if he earns $60,000 versus $6,313 if he earns $50,000. So we essentially net the two, and we see in this case the difference between the tax would be 2,200, and the difference in income would be 10,000. So what we essentially did is we divide the difference between the tax due by the difference in income. So 2,200 divided by 10,000, the marginal tax rate for Glenn is 22%. So this brings us to our last question. And here it asks us, what is Jim's after-tax cost of his house? Jim has a house payment of $2,000 per month, of which $1,700 is deductible interest and real estate taxes, with the remaining $300 representing a repayment of the principal balance of the note. Jim's marginal tax rate is 30%. What is his after-tax cost of his house payment? So in order for us to determine it, we need to figure out, all right, what is the total payment? And in this case, the total payment is $2,000. We're going to make this a little bigger. So in this case, the total payment is $2,000. Now we need to determine what is the amount that impacts, what is the after-tax cost? How do we determine that? The deductible portion times the marginal rate. So in this case, the deductible portion is $1,700, and his marginal rate, as the problem lets us know, is 30%. So 1,700 times 30%. So we less the tax benefit. All right. So in order for us to determine the after-tax cost, it is the total payment minus the tax benefit. So therefore, Jim's after-tax cost is $1,490. So again, how do we calculate that? In total, Jim pays $2,000. The deductible portion, we wanted to figure out, well, what is the tax benefit of him getting to write this amount off? So we needed to do some extra math. So the $1,700 times the marginal rate of 30%, the tax benefit that Jim gets from the deductible portion is $510. So $2,000 minus the tax benefit, the after-tax cost is $1,490. All right, so this brings us to the end of questions for Chapter 9, which covers employment, taxes, estimated payments, and retirement plans, in Chapter 12, which covered tax administration and tax planning.